Hello, good day to all. This is Kelvin here. Welcome to a brand new trading week ahead, as well as the kickstart of a new month of March. Welcome to this week's latest edition of my weekly technical outlook on the major stock indices. So, as we know that last week, in fact late last week, we do have a kind of a negative reaction on almost all the major stock indices. It started off from the US big tech, which is the Nasdaq Hundred, and it started to spread to all the even these heavily cyclical and value weighted indices like the Dow Jones, the Russell 2000, the S&P 500 definitely, and as well as spreading to the Hong Kong 50, the Japan 225, as well as the German 30. And as you all know, that the main culprit will be this rising US Treasury bond yield. In fact, it's not only in US, and in fact, this rising yield is a phenomenon that we see in the last 1 to 2 weeks across the globe. Later, I'll share with you all on the key technical chart on the US 10-year Treasury yield. So before we start, let's take a look at the disclaimer slides first. Okay, so let's have a recap on the weekly performance on the major stock indices across the globe. So in fact, all of them are in the red. S&P 500 down for the week of last week, negative 2.6. Nasdaq 100, negative 4.9%, which is actually its worst weekly performance since the medium-term uptrend started on the week of 22nd of October 2020. And the Dow Jones faring much better, negative 1.8% due to its overly heavily concentrated weightage on the cyclicals instead of technology related stocks. The Nasdaq, pardon me, the Russell 2000, a small caps stocks index, negative 2.9%. Hang Seng negative 5.4%. The worst hit is Hang Seng Tech Index, negative 15.2%. Basically, two main reasons that causes this drastic negative performance on the Hong Kong or the China big tech stocks is actually due to number one is the rising yield treasury yield curve across the globe, or I'll say that rising sovereign bond yields that hit these the tech stocks, and as well as on the localized factor in Hong Kong, which is on last Wednesday, the Hong Kong Stock Exchange actually increases its stamp duty for stocks trading, which is kind of a tax on trading the stock across the Hong Kong in the Hong Kong Exchange. It actually increased from 0.10% to 0.13%, the first increase since 1993. So all these kind of a fit into a negative feedback loop into China-related big tech stocks. Then the Nikkei 225 is down by negative 3.5%. The one that is outperforming, which is the German DAX, is only down by negative 1.5% for last week. Then a quick recap for the month as well as year-to-date performance. So as you could see, majority of them are still trading positive for the month. Okay, so the top performer for the month as well as year to date still remains on the US small caps, which is the Russell 2000 at plus 6.1% for the month of February. Year to date is now have an accumulated return of positive 11.5%. The one that is kind of lagging behind or the worst underperformer across these indices that I covered or that I tend to watch is the Nasdaq Hundred, which is the heavy concentrator on US mega big tech stocks, negative 0.1%. Year to date, only up point marginally by positive 0.2%. So the Hang Seng Tech, in fact, initially it was actually pretty positive for the start of this for the month of February. So the bulk of this positive return has been wiped out last week due to its negative 15.5% decline. So for the month of February, it actually shed negative 4.3%, but year to date is still positive by 9.8%. All right. So let's take a look at this. One of the major catalysts that trigger this across the board, kind of a risk-off scenario for the global stock indices is this rising U.S. yield, 10-year yield. So why is it important? Is because number one, the rate of we're talking about the rate of increase. All right. So number one, everybody's saying that yes, rising U.S. yield is actually positive for the economy. Why? Because we're talking about economy is now opening up, talking about more vaccination roll up, so it actually brings more positive growth globally, as there will be this pent-up demand that should come back into the second half of the year. But however, a rising yield curve also represent indirectly the cost of capital. We look at it as a cost of borrowing for corporates, because treasury yield is kind of a benchmark that is being used as a kind of a risk-free rate plus certain percentage above it to for the banks or for financial institutions to actually give a kind of a rate for a borrowing rate for corporates. Yeah, all right. So corporates that has better credit standing will have what I call the 10-year yield plus only a small magnitude of percentage increases markup. Corporate that has bad credit standing will have a higher markup. So if this risk-free rate or 10-year yield start to increase too steeply, that means i.e. the rate of jump starts to go up by too fast within a couple of days, means too fast too soon, it tends to actually create a kind of scare or liquidity squeeze, we call it in the financial system, to actually have this kind of perceived sentiment where the market's participant will say, hey, the cost of borrowing or the cost of capital has starts to increase as well. So that kind of outweigh the benefit of a rising yield that translate to a global economic growth. So because of this steepness that was seen last week, if you look at last week push up, that create a kind of negative feedback loop. That means, i.e., markets are more concerned rather than a representation of an improve in global economic growth. But technically, what's so interesting is that if you look at the last week close, which is at 1.4%, it almost hit a high of 1.6 last week. And thereafter, towards on Friday, it actually toned out a bit. So what we could see is, for those who knows about candlesticks, last week candle actually ended with a long-legged doji. That means bulls are getting a bit of hesitant to push prices higher, and this long-legged doji, or in fact we can somewhere can call it a shooting star as well. This weekly shooting star, which is a bearish reversal candlestick, where does it stop? It in fact stop at a graphical major resistance taken from the previous range, because the previous resistance range support that was broken now turns into a resistance. Quite some time back, it will be at 2012 all the way to 2016. So we're talking about a very long period of significant level that market has memory back again, and where it stored, it actually stored right at this zone here, which is 1.38%. The upper level will be at this 1.57%. So what's 1.57%? Is in fact the 38% retracement of the previous down move from this 2018 high of 3.24%, 3.25%, all the way down to the low of 0.31% during this terrible period of this COVID-19 pandemic, the worst of it. Then we also have a Fibonacci extension of 1.618%, or Fibonacci expansion we call it, stopping at this 1.618%, which is 1.7, which I get derived or 1.57. All right, so we see a clustering of important graphical resistance with Fibo retracement, Fibo projection, as well ended with a weekly bearish reversal long-legged shooting star pattern, which in candlestick we call it a reversal candlestick, indicating to us that the up move here seems to be a bit of exhaustion. And also, if you look at the RSI on this is the weekly RSI, it already hit the overbought zone, exited the overbought zone at 70, now coming close to this extreme overbought level at 75, that actually correspond to 75.6 previous peak that was seen on the price action that give rise to some pullback. This one give rise to the pullback. Also over here, it actually give rise to this drastic pullback. So for sure, we cannot know how drastic the reversal will be, but at least for now, this 1.38% slash 1.57%, it seems to us that it may give a bit of pause in this rising yield. The support level to watch, or I would say the key support level to watch in the medium term, we're talking about 1 to 3 weeks, will be at this 0.95%, capping potential setback that is potentially coming into at this juncture, which is this week, at 0.95%, should cap this potential setback or pullback for now. That means if we translate it to a potential movement for global stock or the stock indices that I shared with you all in the last few weeks in my usual weekly outlook. It kind of provide a bit of comforting for the bulls, or for to reverse last, or to actually put a halt or negate last week negative risk of behavior on the global stock indices, which i.e. it seems to be potentially positive for this week. All right, so now let's go on to the individual technical chart, the trend bias, the new key levels to watch in this coming week, okay, on the major indices that I covered. So before I start on this the various major indices, a quick recap: only two major indices that I covered last week, which is the Nasdaq 100 as well as the Hang Seng Index. They broke below their tightened key medium-term pivotal support. The Nasdaq 100 is at 13,190. The Hong Kong 50 will be at this tightened pivotal support at 29,350. All right, just bear that in mind. Okay, so now let's move on step by step first, or let's cover each individual one, starting from the US. All right, so before I start on the S&P, the SPX 500 as a Nasdaq 100, one of the proxy that I like to share was, in fact, I tend to share in all my weekly outlook before I start, will be the semiconductor ETF. So as a quick recap, why semiconductor? Because semiconductor is actually also a proxy of growth. Any sign of exhaustion in this semiconductor ETF, we call it SOX in short. All right, it will actually kind of reduce the probability of any potential medium-term uptrend or recovery that we're going to see this week. All right, so last week I have a tighten key medium-term pivotal support at 41360, which is this level. So in fact, the price action for this not Nasdaq, semiconductor ETF SOX actually kind of flirted or tested at this level, but on Friday it managed to actually close above at 411360, which is last Friday closed at 416.66, and it also managed to hold above the rising 50-day moving average. RSI also holding above this correspondent key support level significantly at 41 level. So what we could see, all in all, there is no breakdown of this revised or tightened medium-term pivotal support I have for last week clearly at 413.60. So in terms of its medium-term uptrend that is in place since 28th of October 2020 low, it seems to be pretty much intact, and it considered to trade in a series of higher high and higher low. So all in all, the next risk, it could potentially shape another potential up leg as long as this level is not being breached for 13.60 to target the next resistance at 458/465.50. So that could actually give us another kind of comforting element or positive element to actually see a potential recovery this week for major stock indices, despite late last week across the board sell off, together with this rising 10-year US Treasury yield that I shared with you all the key technical elements a while ago, that we may see a pause below the major resistance at 1.38%/1.57%, maximum towards this 0.95% a key medium-term support on the 10-year yield. So we have two supporting intermarket, or I would say cross asset class, that may see a potential, or that may trigger a potential recovery for major stock indices for this week. All right, so now let's kickstart first on the major stock indices that are going to cover with you one by one. Will be the S&P 500. So let's start off with the longer term chart, the daily chart. So we could see, very interestingly, last week the S&P 500 still managed to test but hold above the 3800 key medium-term pivotal support, which is also the 50-day moving average, and as well as this long-term major ascending channel support that is in place since 23rd of March 2020 low. And what interesting over here is that the RSI also managed to bounce off from a significant resistance, or significant support at the 42 level. All right, from here, which is also the ascending trendline support that is in shape or in place since 26th of Feb 2020 low. So go on to the strategy chart, which is the 4 hour. So still unchanged. I will still use the 3800 level as my key medium term pivotal support for this week, looking for another push up or another recovery to actually test this 3960 slash 3990. A break above may take us higher towards the next resistance at 4080 slash 4100 level. But nevertheless, if we start to see a daily close below 3800, we could actually see a further extension of this corrective decline within this major uptrend that is still in place since March 2020 low, to target the next support at 3640 slash 3580 over here. Okay, now moving on to the Nasdaq 100. Okay, so going through the Nasdaq 100. Okay, so Nasdaq 100 is a bit it's more weaker, as it's actually breached below the 50-day moving average, whilst the S&P 500 I highlighted earlier on, it still managed to hold above the 50-day. Why? Because of its heavily weighted on the FANG stocks, which is the mega cap big techs, which is comprises of Facebook, Apple, we talk about Google, we talk about Netflix, as well as Microsoft. So all these stocks, big tech stocks, are heavily sensitive indirectly to a rising yield curve, sovereign bond yield curve. So with just now I shared with you all that the 10-year treasury yield seems to be taking a pause below its major resistance at 1.38% slash 1.57%. It could add a bit of comfort for last week drastic sell-off on this Nasdaq 100. So what we could see over here is that I still maintain that bullish bias, but what we do over here is that I have a trigger level for me to be more confident to actually play this potential recovery for this this potential recovery scenario on the Nasdaq 100. So also why I have this still have this bullish recovery or bullish bias on this Nasdaq 100 is because of the shorter term 4-hour RSI. So I want to share with you all this RSI is the momentum. It's actually the momentum indicator to indicate whether current downside or upside momentum is being overstretched. So let's take a look at what we see last week. So last week it actually shaped a lower low, okay, lower low. But what the RSI display, it display a reverse behavior of this price action lower low. So instead the RSI shape a higher low. And where does it shape? It actually shape at this extreme oversold level. So what it indicated to us that based on this RSI, this last push down here based on momentum is kind of extremely oversold, extreme momentum on the downside, where we could see a capitulation of the bears for a potential reversal. All right, so what happened over here, it also happened in the past. Take a look here, it also hit the oversold level, means going beyond 20%, the 20% mark. Okay, so for RSI, a quick start is that any level below 20 is considered traditionally as a extreme oversold region. All right, so it hit below the 20 mark, also shaped that bullish divergence, lower low, higher low. So this gives rise to the previous recovery on the Nasdaq 100 over here as well. During November last year, lower low, hit the beyond the 20 level, below 20, which is the extreme oversold condition, also shaped this bullish divergence, higher low, and thereafter it kickstart this ongoing medium term uptrend that is in place since 3rd of November 2020. So given the behavior or the observation that I see on the 4-hour RSI, and plus what we see the technical configuration on the US 10-year yield, so I will be very hesitant to actually turn bearish at this juncture, to actually say that we may see a further extension corrective decline. So with that, I have 12780 as my key medium term pivotal support for this week, which is last week's swing low, and as well as it corresponds to the previous range support of 13th of Jan to 30th of Jan 2021. So if I were to draw a Fibo retracement, it actually has a confluence with two different aspects of it, taken from the start of this medium term uptrend, which is November low, okay, over here, all the way up to the current all-time high. You see it stop at 38%, 38.2%. And if I take it from another angle, from here the start of this wave 2, which is at 10th of November low. It actually stopped at 50, yeah, close to, okay, 1 second, let me highlight to you again. From here, 38.2, okay, sorry, my bad. Okay, this is from the low of 3rd of November, 38.2%. If I put it the different low, a different swing low, which is from the 10th of November low, it actually stopped at 50% retracement mark. Alright, so we see a confluence of different Fibo retracement cluster with graphical key support level that is hitting 1, 2, 3, 4, 5 times 12,780, coupled with a bullish divergence that was seen in the 4-hour RSI. So this give me to maintain my bullish bias for a recovery on the Nasdaq 100, but definitely to further reinforce my recovery scenario, it got to have a clear breakout above 13,560 for it to actually target the next resistance at 14,100 slash 14,190. Okay, now moving on to the next indexes will be the Hong Kong 50. So in fact, Hong Kong 50 is the one that I mentioned earlier that broke our Titan key medium term support last week, which is 29,350. One of the trigger will be the surprise increase stamp duty on Hong Kong stocks that is traded over the Hong Kong exchange, or announced by the government on last Wednesday. So what we see over here is, before I start on the 4-hour chart, let's go to the daily chart first. So if we go to the daily chart, so what we could see that the RSI is still holding above this support level here. If I could share with you, okay, at this 45 level mark, over here where the price action rebound as well, take a look at my cursor. Over here the price action stage a recovery, right over here the price action stage a recovery, and right now is bouncing at this level again, which is the 45 level mark. So based on previous observation, it seems to me that this 45 level mark on the RSI actually potentially could give rise to a rebound in the price action of this Hong Kong 50 index. And right now it's also coming very close to the previous swing high area of 17th of Feb, previously tested on 29th of Jan, stage of recovery, now acting as a support at 28,600 level. Right now, go on to the 4-hour chart. So if I go to the 4-hour chart, so that's my strategy. So what I do is that I still have this recovery bias scenario in mind, using 28,600, 28,060 as my key medium-term pivotal support. And if you look at the 4-hour RSI, also hit the extreme oversold condition, and now trying to actually exit from the oversold level, giving another sign of positiveness in terms of momentum on the shorter term. So what I have that's similar to the Nasdaq 100 is I have a trigger level at 30,160. So what is 30,160 is in fact the previous swing low area that was broken down on last Wednesday after the announcement of this increased tax hike, trying to actually test above it, can't break, and start to shape this drastic decline on last Thursday and Friday. So this 30,160 will be my upside trigger level. You got to have a clear decisive break above it to actually reinforce my recovery scenario to target the next resistance at 31,600 for the for the Hong Kong 50 index. All right, so now moving on to the Nikkei 225, or we call it the Japan 225 in our trading platform. Okay, let's give a bit of time to load. Okay, now let's start with the daily chart first. So as you could see from the daily chart, since the low 30th of October 2020, where the start of this medium term uptrend that is forming within a major uptrend that is still intact since 16th of March 2020 low. So this medium term uptrend, right, ever since this medium term uptrend started, the price action did actually break below the 50-day moving average. So what's interestingly over here is that last week decline, or that pullback since 16th of Feb 2020 2021 high, which is at this 30,716. All right, managed to actually start close at this 28,900 level, which was last week key medium term pivotal support. Then right now the 50-day moving average will come to support in a couple of days time. And what interesting over here is that if you look at today's rebound, it actually tests at this key corresponding support level that I draw on the daily RSI, which is bouncing off close to the 50 level mark as well. So what we could see is that daily RSI momentum seems to us telling us that it's bouncing off a key corresponding support level, indicating to us that medium term momentum is coming back into the picture for the Japan 225. Price action seems to be supported at the 29,900 level by the 50-day moving average, as well as the previous day swing high area. And if I could draw a Fibo retracement level, all right, taking from the start of this medium term uptrend that is in place since 30th of October 2020 low, all right, if you see where it stops, it's actually at right at the 23.6% Fibo retracement. So now going on to the 4-hour strategy chart. So what I have over here is the RSI also pretty positive on the shorter term, hit below the 30 level, coming into the, we call it the oversold or the extreme oversold region, bouncing off from it, exiting from it, indicating to us that short-term upside momentum is coming back into the picture for this Nikkei 225 or Japan 225. So as long as this key medium-term pivotal support holds, same as last week, never changed to 8,900, a clear break above 29,900 level. Where's 29,900 level? Is in fact this descending intermediate or descending short-term resistance taking from the high of 16th of Feb, linking the previous higher lower high. A break above this level at 29,900 should actually reinforce our view, our bullish impulsive view for another up leg, potentially to target the next resistance at 30,975 slash then thereafter a break above 13,750 should take us up higher towards the next resistance at 31,350. All right, now moving on to the last index will be the German 30 in Europe. So you look at the movement of German 30 is pretty unique compared to the rest of the world. One is because it's heavily weighted according to cyclicals in terms of banks and as well as some old school industrial stocks in the 30 this 30 component index, 30 stock component index. So that's why it didn't actually fall that much for last week. So in fact, if you look at since the start of February, it's been trading pretty sideways, holding above this 13,700 level. All right, and definitely the key major support zone will be at this 13,300 slash 13,050, which was this former descending resistance from 20th Feb 2020 high, now turns into a pullback support. Also confluence with this long-term, or opposite, pardon me, major ascending channel support in place since 19 March 2020 low. RSI right now seems to be positive. Right now it seems to be bouncing off from this corresponding ascending support in place since 30th of October, which is correspond to the start of this medium-term uptrend. All right, bouncing off from this corresponding support at the 45 level mark. Now moving on to the 4-hour chart. So as you can see, it's pretty much sideways. Last week, 4 managed to actually stop right at our 13,700 key medium-term pivotal support, so still no change. And what's positive is we see a series of lower low, this low, lower than this low, this low, lower than this low, and look at the series of lower low is being formed. The RSI in fact is not shipping lower low, it's in fact shipping higher low, indicating to us that this short-term movement down since the high of 15th of Feb, it seems to me that is the downside momentum has started to ease off, which is seems to me that is pretty positive for this index. That means we are saying that potentially we could start to see a recovery play from here, but nevertheless it got to break above this descending short-term resistance that has kept previous push up or previous recovery since the high of 8th of Feb, now acting as a resistance at 14,750, 14,075. So as long as 13,700 holds, no daily close below 13,700, I'm still favoring this recovery play, potential recovery play for the German DAX to shape another impulsive up leg. if we see a clear break above 14,075 to reinforce this potential preferred bullish impulsive uplift scenario to target the next resistance at 14,315. Going above it should actually take us much higher towards this 14,570 slash 14,730. Okay, so that's all in all what we could see right now. I've recovered across the major stock indices from US, Asia to Europe, and as well as two key cross asset classes, which is stocks, and as well as the most important US 10-year Treasury yield. So if we look into a clearer picture, not taking into account of last week late sell-off, overall the medium-term uptrend seems to be still intact on these major stock indices. Definitely the weakest one that I cover will be the Nasdaq 100. So as long as this key support level still holds, we are still in favor of a potential uplift to be in play for the next 1 to 3 weeks for these major stock indices. All right, so do keep a close watch on the levels that I highlighted to you earlier in my video. So that's all I have for now in my weekly update on my latest weekly technical analysis outlook on the major stock indices. Have a great trading week ahead, and I see you on next in my next video.